Hey, how you doing? Welcome to the channel. So today we're going to go over some stock market stuff, kind of see what's going on this morning. It looks like we're kind of continuing our sell-off. So let's go over there and kind of figure out what is going on right now. All right, share that one. Okay, so here we are. I got my real time up. Okay. Yeah, so right now the S&P, it gapped up a little bit there and then kind of sold off, and now it's starting to come around again, come back up. So we can see that yesterday we had this big sell off, and then it recovered a little bit into the open, and then today they tried to gap it. But you can see it's interesting, right? The whole bar just really gave up a big chunk of the gap. So it sort of like seems like it's sort of an artificial gap. I wonder if they do that sometimes. They try to just they kind of just try to force that open up against what even like the market can handle. It seems like sometimes they do that because you see these big gaps, and conceptually how it works is that, well, if they are able to get that open up there, even though it reverses, they absorbed at least some of the selling pressure that maybe was there. So that's kind of interesting there. So I guess what's going on today is what's going on today? So we're looking at this, the 10-year yield, and see 10-year yield, spiked yesterday and then today gapped up. So, but it's interesting. There seems to be some movement to the yield. So it's reversed. So but it looks like there's some pressure for it to go down. So that would be interesting. That might take some pressure off the market. The higher this rate goes, the more pressure we see on the market. Let's look at like Tesla, some of the high beta stocks here, and see what's going on. Yeah, this one just getting cleaned, getting its clock cleaned here, Tesla. I had that put on it. Let's see what's Grayscale. It's doing that. Yeah, I had that put on that Tesla. So this is not financial advice. This is just me. And I had put it up here. I had basically that was like one of the few times I didn't do it right. But this it got down, failed, and put somewhere in there. I got to put, and then I closed it yesterday. But see, today it's extending its way down further. But I just, you never go bankrupt taking a profit, so I'll just take a profit. So that one was cool. So that was one of the $71 to 102, but I just had one, so it's not too much. But you want to keep it. From my point of view, it's like I've learned that like options have to be kind of really small amounts because very often they go to zero. When you're buying them, they very often go to zero, so you really can't have much in it. And then so when it turns on you and it gives you the option to make a decent chunk of money, it's like it behooves you to take it. You just take it. You don't argue with it and think about holding it and getting more greedy with it, because you just like it'll turn on you. Because with these options, what's happening is, the thing is, what you really need is for a put, for that to work like it worked, is really had to take a lot of selling pressure. It came out of the money into the money, and it needed a lot of selling pressure. It really had to get knocked down. If it only went down a little bit, then that option may have actually lost value, because, I'm in an option that's expiring in April. So it's a little over 30 days away, but it's still not that much. It's somewhere in the last, you can't tell where it's going to be, somewhere in the last, few weeks for sure, or maybe in the last 30 days, that option is going to start, the time decay is going to start moving on it, and you're going to start losing more money if it's not in the money. Well, no, you're going to lose the extrinsic value. It doesn't matter if it's in the money or not in the money, but the extrinsic part, the part that is not in the money, you're going to start losing more on that as it gets closer to expiration. So so that's why I just kind of take those when they come. I have one on GME too. In this one, I'm just sitting on it. See, this one I'm liable to lose money because I'm just sitting on it right now, because it's just, I've lost money on this option, this put, and it's kind of like surprisingly how well GME is pushing up. I was watching these videos yesterday, and gosh, guys are like talking about big whales and how big whales are in at this price or that price. And yeah, I don't know. I mean, how hard is it for someone to type up an email or, put a post out on Twitter claiming they're this, that, or the other thing? It's like, I don't know, utter nonsense. But I must say that I'm impressed how it's holding up right now. So like if we did something GME over the SPY to see how strong GME is relative to the SPY, you can see how these are fractions now. It really just looks like the GME chart because the GME is very strong. So for example, if you did SPY over SPY, so what you're doing is dividing. So you're seeing how they're running to each other. So you see the SPY to the SPY, it's got this flat red line. That's interesting. The intradays are showing up like that. But yeah, so you can get a feel for how things are moving relative to the major indice. And then like here, this one here, Tesla. So you can see Tesla is interesting. Why is it? Oh, but it's a static price, right? So yeah, so it's in terms of the price, it's higher, but you can see that it's moving. It's been moving down relative to the down more than the spider itself. So yeah, so let's see. Let's look at some of the high beta today. I don't know. These guys are. I mean, CCIV. Look at that one. See, this one's been dog meat, dog meat, dog meat, dog meat. And look at it now. It's breaking below the moving average. I mean, if you're buying this thing, like you're buying that, what is it, merging with that car company or whatever, and it's like, you kids, you kids, what the hell are you doing? This is how it works. Just so you understand, every generation has to go through their like stock market crash and has to, because this is how it works. It's like, just so you understand, you become a young adult and you think you're smarter, of course, than your parents. You think like, oh, the experts are idiots, and you know better. And you're like, so what's the thing now of the younger generation? You guys are all like, oh, Wall Street bets, we can take on the big guys and we're smarter than you and Bitcoin and this, that. And it's like, okay. And whatever, non-fungible tokens and like, okay. But it's kind of funny because it's like at the end of the day with all that stuff, it's like, okay, well, the thing has to be an investment. It has to like produce something so that you can hold it, you can't just keep putting money into stuff that isn't giving you a return because eventually you run out of money. And eventually the government, trust me, eventually the government, like I know the stimulus is coming, right? And that is going to pump this market something, I tell you. But the thing is, the thing is the government can't keep doing that forever. So here's the thing. This is a really good thing to understand what's really happening here. See, this 10-year is going up. Now, in the big picture is going up in the last year. It's going up. And actually what's interesting is it's starting to break above stuff from a year ago. No, not quite yet, but it's pushing. It's knocking on the door of trying to get above these. See, it's breaking into this resistance. Right? Support. How do you know this was support? You didn't. When it was coming down, you didn't. It just started going back up. And then when it came down here, it actually broke through the support. How do you know that this is support or this area is support? You don't. You just got to be. It's this sort of an area where it changed direction and started going back up. That's support. It's by definition. It's a definition of itself. That's what it is, right? And you have all these like methods to try to predict where that is. But like, for example, on the way up, support, you would hope and expect that it would be at a moving average, or, the Fibonacci people are like, oh, it's a certain ratio down or whatever. And it's like, okay, well, none of that really means anything after the fact. It's just an area where for whatever reason, it found support. So over here, you're like, okay, it's coming down. If it's going to stop going down, you'd expect somewhere in this range here where these lows were that's where it found, and it happened to do that. Okay, so now we're on up. So in the big picture, it's important to keep in mind that like, look, rates are going up. Well, yes, they are going up, but they're only like from like 2019. So was it the end of the world in 2019? for rates? No, no one was worrying about rates and then. So we're not even back up to the rates, the interest rates that we had in 2019. So first of all, that's something to kind of understand, that it's like overbaked, right? It's overbaked. But the other thing to kind of keep in mind is that this these rates going up, and this is what people talk about, and you hear people talk about it, and maybe you kind of ignore it, because I mean, I get it. If you're spending all your time and you're trying to you're just like, oh, what's the next GameStop and the next GME, you're not paying attention to people that are telling you that, like, you got to watch the bond market. It's bigger. It's like much larger than the stock market, and it pushes it. You got to understand. And so this is what's happening. And so this is why you're having the problem. Look at the 10-year. See, things are usually relative. So you're down in here and you have low rates, and rates have always been dropping for a very long time. But this may be a turn of events. The rates are coming back up. And so what is the problem with that? First of all, it starts to become a problem for the economy. So once again, it's all relative. As I said, the absolute rate is still low. It's still below how it was in 2019 and any time before that. Like, we go out to a large chart, it's still, really at lows. But the problem is it's moved up a lot from where it's been relatively recently. And so that's a potential problem. Now, why? Because the 10-year is the rate that kind of matches the real economy, particularly like housing, right? So most people get like a 30-year fixed on housing, but the reality is, they don't own the house for 30 years. Like, a lot of people will 7 years, 8 years, 9 years. So that's where the 10-year rate comes in, right? So that thing goes up, it's going to affect that. It's also going to affect cars, even though, well, now cars are becoming more like 10-year loans. They didn't used to have that, but they would have 5-year loans, 3 and 5-year loans and stuff. So once again, so it still is an indicator of that rate. So the 10-year is like a real, like, the 30-year isn't really a indicator. And like the 3 months, 6 months, 1 year, that's really not an indicator of the real economy. Because, like, if you're a person, like, I tried to do this one time, a long time ago, I'm like, oh, I'm going to try to get a personal loan, an unsecured personal loan, not through a credit card at a bank. It's so funny. They'll be nice to you, but they're never going to give it to you. They want it secured, right? They'll just never give you that money. They will on credit card, but they're charging you usually a lot more of a rate, so they just take the risk on the credit card. But yeah, so here's the problem. So if this is pushing up, why does it put pressure on everything, though? And because it's a real rate of the economy. So you're talking about, oh, the economy is opening up, and it's the recovery is gonna go because of the opening, but this increase in rates is gonna, has the potential to hit everything. This is gonna bleed into the price you're paying for home mortgages, right? So that puts pressure on price. I mean, what you pay for a house is like, it's all interest rate. It's all interest rate because you have this 30-year fixed mortgage. So like, the rates going up 1% or 0.5% has a huge effect literally into what you can afford to that payment, which directly affects the price of the house. So that's one concern there. It also affects cars, like buying cars and stuff like that. Forget it. And then the other thing is it affects all the financial companies and all that. So basically just this ability to borrow money, it's going to cost more. You have all these companies, you got to understand, like, our economy cannot function at reasonable rates anymore. That's what's lost in all this. All this stuff that the Fed has done, it's all this stuff over all this time. I'm going back to the 90s, and just, yes, wide range, but the reality is that rates have been just going down and down and down. You can draw your channel or whatever, wherever you want to draw it. But the simple fact is, for, forever, like going back to the 80s, whatever, rates have been coming down. So that environment encourages what? It encourages people to borrow money, but also businesses to borrow money, banks to lend money, all that stuff. And all that stuff. The problem is, you have an economy that is addicted to this. It can't, like, there's so many companies operating right now that if rents, here's the thing, like, if you go back in time, I don't know what a reasonable rate for some of these things might be, but if you were like in the short term at like 4% up here, 4.5%, right? If you were up there, like, a large number of businesses would just go bankrupt because they're not profitable enough to pay for debt. Okay. Right. they're not profitable enough to be able to pay a reasonable rate, like a reasonable, like 4% rate on borrowed money. And that's kind of the thing. So that's what's happening. So that's why the stock market is getting concerned about the bond market, because the economy of all these companies can't handle it. And especially all this high beta crap, your CCIVs and all this stuff, I mean, they can't function on like a 4% interest rate, like a Fed rate up in the 4% range or something like that. They can't function, right? Because then they'd be borrowing money at 10% and they can't function. I mean, they're losing money as it is and they have to borrow more. All these companies, even like a Tesla, they got to borrow money too. They tend to do more of the stock issues and stuff like that. And then all these the recovery stocks, the CCLs, these guys, now, these recovery stocks, they're going to have to pile up on debt. Like any, yes, there's optimism and there's probably overshorting that has gone on and they're starting to recover because, if they're going to open up and start having cruises again, okay, the money will start coming in. That's all good. But the other side of the coin is they have to probably raise money. And if they have to raise money, the rates going up is going to affect their profit margin. So it's really interesting. It's a really simple thing to see. But then really, so what is the big problem with the rates going up for the stock market? So this is like the Meet Kevins of the world that don't understand this stuff, is like the real issue that rates gone. And one issue is that they've gone up really fast, really quick. This is a daily chart. These are significant moves in rates quickly. So quickly moving anything is bad, right? When it comes to rates, currencies, things like that, them moving quickly in either direction is bad because it makes it very hard for companies to plan. Like if they're out there and they're saying, hey, look, rates, we expect them to go up and they're going to be going up maybe 0.5% or so, whatever the number is, they can kind of plan for it, but they can't plan for sudden big moves. It makes it very difficult. And if they're on short term, et cetera, blah, 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 it's a real big problem. So what's really spooking the market about all this is that they're like, well, why isn't the Fed stopping it? And that's a really good question. Why isn't the Fed stopping? Why hasn't the Fed come in and just bought a bunch of 10 years, just over flooded the market with demand to push this back into the channel? Why haven't they done that? And the answer is, I don't know. So it's either two things. Either one, they're not paying attention, or number two, they don't care. And they're like, well, we don't want to mess with that market. We don't want to do yield curve control, that stuff yet. Or three, they kind of try to, here, you can look at this day, it spiked up and they brought it down halfway from where it was at the high. But maybe the other answer is that's all they're able to do. And you can say, well, how could that be? How could the Fed that can basically create money out of nowhere, the only entity that truly can create money out of nowhere? Well, no, the banks do. When you take a loan and stuff, yeah, they create the money. But the other side of the coin is the Fed also can kind of, yeah, they create money too, because they're a bank. A bank can create money. But so why would this organization that can create money out of nowhere, why would they let this happen? And so I don't know. I mean, my speculation would be look, they don't want it to happen. They don't want rates to spike up like this, but they can't do anything about it. Maybe they tried some things and they're trying some things right now, but it's not working very well. You have to understand these are a very large market and there's so many moving levers. I mean, it's literally, and I know you kids don't remember this movie, The Wizard of Oz. And The Wizard of Oz was this movie from the late 30s, and Dorothy, and she's lost in this place and blah, blah, blah. And she goes to see, the magical Wizard of Oz. And it's this big, stage and this big face and this talking stern voice. And then the little dog goes behind this curtain and it turns out to just be a man pulling levers on this fancy machine to make him look and sound like a great god, and that's kind of what the Fed is. The Fed is, the Wizard of Oz, but it's really just some people behind a screen pulling a bunch of levers. And it's funny because in that movie, he's desperately pulling the levers and trying to manage all the levers to make him sound very authoritative and very scary and everything like that. It's as if he's controlling a dragon, and it's you're trying to control all the levers. And it's kind of funny. That's kind of what the Fed is. right? The Fed is trying to control all these levers to try to sell everyone that they have everything under control. But when this happens, the real problem is that they don't have it under control, right? And whether they want to have it under control or don't want to have it under control, it kind of doesn't matter. The fact is, it's not really under control. The rates are going up too fast. And so, as I shared before, these rates are not like super high, like we're talking about that, right? Like these are like hasn't even gotten to the where rates were for the whole year of 2019. So it's not a big deal. But the problem that you have is, you know, all these entities kind of get themselves really just used to the low rates. And when they start going up and they start going up too quick, it causes problems for them because they're just not prepared for it to move that fast. And so I think sort of my speculation would be the real issue the market has is that, like, what the hell is the Fed doing? The Fed has lost control of this. And it's funny because you got the Van Meter guy out there, the bond king. And I think he sees this, but his whole premise is, one of his premises, like there's going to be a bond bull market because the Fed's going to come in here and they're going to hammer this, right? They're basically coming in and buy so much of it. And remember, when rates go up, the bond value goes down. That's what it means. That's why this is a concern, because this is investors and people selling bonds. So they're selling bonds. So remember, all that debt that's piled up, that whatever, 27 trillion in debt we have right now. This indicates that people aren't buying that debt. They don't believe in it. They're not buying that debt, right? That's what it's telling you. So that's the other side of the coin. You know, the government can't just infinitely promise $2 trillion bailouts forever and just hand money out. They can, but that's where it comes up in the bond market first, and then later it will show up in the dollar. So that's kind of what the important thing is. So, you know, it's kind of interesting. So like you see these days where they hammer, you have a tall wick on the top indicating that it traded up there, and then they hammered it down for the close, knocked it, the yield back down. And so here, that's what's going on right now today is, you know, it gotten up to 1.6% and it's hammered back down. But so maybe the Fed is out there, maybe they're trying to do it, but they're not being that successful. So, and this will affect all that stuff because especially you're trading this crap, this CCIV crap, this even Tesla, you know, you're trading Tesla. And I mean, it's very clear Tesla's a real company. And I think they're going to be around. They got a lot of stuff, but the pricing is, I mean, you're pricing in a place where they're going to be in 10 years, probably. You know, you're paying for where they're going to be in 10 years now. So that's what the problem is, you know? So yeah, real company, I think it's going to be around, very innovative company. You know, they're going to be here. Like, I think even the bears are like, yeah, no, they're going to, you know, they're going to be here. They just is like, look, the valuation is out of hand, you know? At some point you have to get to some realistic point in your stock trading. Like if you're going to buy the thing, and here's where like the Kev dude and all these people get like a little out of hand. They're like, they'll pick a price. So they'll do some fundamental analysis and say, hey, like this under whatever arbitrary point, hey, Tesla below 600 based on what that means based on my estimates of future earnings. That's a value. But remember that value, like there's always a P to E, price to earnings. And these prices, like still, like a lot of these prices are in the 20s. 30s, 40s. I mean, stuff like this is, I don't know, in the hundreds, or there isn't a price to earnings because there was no earnings, right? And so yeah, so you always have to remember that. So in trading, you got to understand that the measuring stick is always moving. See, like there's no law that says, oh, it's reasonable to pay a price of earnings of 20 for a company that's actually earning stuff. Right? There's no like rule that says that, and that value moves. So when you look at the overall market and you look at it over time, what's happened here? What's the difference here? You know, what was the difference from this low to here? Well, some of it was the economy actually recovering, some of it things not being as bad as they were. But the main thing that this price move is all about is about what you're paying for price to earnings for those earnings. So you're paying 20 for each dollar, $20 for each dollar earning, 30, 40, 50. And the biggest thing that happened from there to there is that the market decided that it's willing to pay much more for that earnings than the amount of earnings. And so that's what you have to remember. So when you're out there and you do an analysis on a stock, you know, the price, that the value that you stick, the multiple you stick on that is a huge thing. And you got to understand the market is repricing that all the time. And hence value investing would be to find a place where the PE is low. So you find a company where, hey, the earnings are still there. They have the earnings, but the market is correcting and beating the crap out of it for whatever reason, for no good reason. And then there's value there. So it's very interesting. This is what we have. So I think that's it for this one. So, you know, see the S&P, this is very not really much on the even on the NASDAQ at this point, as far as the indice goes, it's not a big thing, but I know that there's people getting hammered in their portfolios right now because they're in a lot of high beta stuff. So yeah, I think the same thing applies. I think that, you know, the way it works too, you know, the higher beta stuff, and high beta just means it's more volatile. It's moving more on a daily basis. So that would be the average true range I talked about. But, you know, when you're in that stuff, so like if you were diversifying, you know, one suggestion, which is not advice, would be like, hey, if, you know, and that's what it is. Like I see, you know, all these YouTubers and all these people that are all in all their stocks are the high beta, high movement stocks. And, you know, if that's the case, it would probably make sense to have some in something more stable, like tobacco or something. I don't know. I know people don't like tobacco, but something that's just more stable, that's more, well, not GE. What would be a more stable? Well, then in an indice that's more diversified. So you have, you know, a more something that with a lower beta, meaning less volatility moving. So that would be kind of the thing to do. So I think that's it for this. So I think for today, I think I have to go get my butt to work. I have to work for a living. That's why you don't follow me, because I have to work for a living still. So see, if you're following someone that has to work for a living, you know you shouldn't be following them, right? Right? Because that means they haven't been successful enough at this other stuff that you're watching to quit their day job. See that? Life lesson. All right, that's it for this one. Bye.